If the US government starts buying Bitcoin, I think you're looking at Bitcoin at 500,000 or $1 million a coin within, a period of a year. Because it won't just be the US government. If the US government is buying Bitcoin, you can believe that nearly every other country around the world is going to buy Bitcoin. But because Bitcoin moves differently than stocks and bonds, because it has what's called a low correlation to stocks and bonds, when you add it to a portfolio, it doesn't necessarily make the total portfolio more volatile. In fact, historically, what you see is you get higher returns without significantly increasing your risk. And that's a beautiful thing when building a portfolio. If Bitcoin is money or gold, Ethereum is technology, sort of belongs amongst the Mag 7 tech stocks, I think that's a good way for investors to start thinking about this asset class.
Matt Hougan begins by making a strong case for every investing portfolio to include at least 2% in Bitcoin, comparing Bitcoin, a $2 trillion global asset, to stocks, which are worth over $100 trillion. Hougan highlights that if investors do not hold Bitcoin at this low level, they are underweight in relation to global benchmarks, basically. It is the same as shorting this game-changing asset. His claim is supported by a wealth of research, which demonstrates that including Bitcoin in a portfolio improves risk-adjusted returns as indicated by higher Sortino and Sharpe ratios. Up to a 5% allocation, these advantages hold steady. After that, drawdown risks intensify. Please take a time to like this video, subscribe to our channel, and enable notifications for future in-depth analyses of cryptocurrencies and the digital asset industry. We appreciate your time, and now let's explore Matt Hougan's revolutionary idea for Bitcoin.
I'd say the starting point is at least 2%. If you think about Bitcoin, it's a $2 trillion asset. Globally, equities are about $100 trillion. From a benchmarking perspective, that gets you to an allocation of 1 to 2%, depending on how much equity you have. And that's just a starting point. If you're below 1 or 2%, I'd argue that you're effectively short Bitcoin versus your benchmark.
How did you come up with this 2% number?
Yeah, I think there are two ways to approach it. So one is that benchmarking exercise, which is just the starting point for most investors should be matching the benchmark of the global portfolio of assets. And again, Bitcoin has emerged as a multi-trillion-dollar asset. So if you have an allocation of 0, you're underweight versus the benchmark. 2% gets you up to neutral. So that's one way to approach it. The other way to approach it is, we've done an extensive study of the impact Bitcoin has in a portfolio over long periods of time, looking at all available data. And what that data shows is that you can improve your Sharpe ratio, improve your Sortino ratio, improve your risk-adjusted returns by adding more and more Bitcoin to the portfolio. Those studies actually suggest that up to about 5% of your overall portfolio, you're getting historically what amounts to a free lunch, which is higher returns with no additional or low additional volatility. From a portfolio construction perspective, I can make the argument up to about 5%, but from a benchmarking perception, 2%, but certainly not 0%. It's really interesting when you look at what would have happened if you added 1, 2, 3, 5% Bitcoin to a portfolio historically. A lot of people think of Bitcoin as this extremely volatile asset, extremely risky, which is true. It is itself very volatile. But because Bitcoin moves differently than stocks and bonds, because it has what's called a low correlation to stocks and bonds, when you add it to a portfolio, it doesn't necessarily make the total portfolio more volatile. In fact, historically, what you see is you get higher returns without significantly increasing your risk. And that's a beautiful thing when building a portfolio. I liken it's a little bit like adding spice to food. If you add a little bit, it makes the food taste better. If you add a lot, for sure, your mouth will burn and it will be risky. That's true with Bitcoin as well. From a short-term perspective, it's absolutely true that if the market pulls back, Bitcoin, which is a risky asset, tends to pull back as well. But what the data shows is that it historically recovers faster than equities. In other words, it gets back up to even faster than stocks do. And then it continues to outperform equities as it rebounds. So if you have a view of the market that's, I'm investing for the next week or the next day, it's not a very good hedge. If you have a view of the market that you're investing for the next year or the next 3 years, it's historically been a very, very good hedge and a very good way to, again, get those higher risk-adjusted returns. So it comes down to your time frame. The reason it's not prudent is the biggest risk in crypto bigger than regulation or volatility or tech risk or adoption risk. The biggest risk in crypto is behavioral risk. And when you start going above 5% Bitcoin, historically, Bitcoin becomes the driver of what's called the maximum drawdown of your portfolio. That's when your portfolio goes from looking great to looking pretty poor during a big market pullback. And in our experience, when Bitcoin starts to be the tail that's wagging the dog of your portfolio, people panic when you have pullbacks. Again, this is a very volatile asset. It's had multiple 50% plus pullbacks. If you put too much of it in your portfolio and we get another one of those pullbacks and you sell at the bottom, then you've done real harm to your portfolio. So you need to have just enough that it influences your portfolio, but you're not going to panic if the bottom falls out, right? I can withstand a 5% loss in my portfolio. We see that in the S&P 500 all the time. I don't panic. But if it was 30% of my portfolio and it had a massive drawdown, I might have a bad behavioral action. And so that 5% limit is designed sort of to protect against that feeling you get in your gut when you have a big market pullback. And that is why we think that's an appropriate level.
With a 100% historical annualized return, Bitcoin has a remarkable track record of attracting investors, which frequently results in leveraged bets and speculative cycles. One notable distinction between these cycles, which are characterized by sharp rises and falls in conventional markets, is that Bitcoin consistently reaches greater lows following each correction. This trend demonstrates its adaptability and expanding worldwide use. As Bitcoin develops more, its risk profile changes. There is now a more stable and predictable market climate, replacing the early days of existential uncertainty. As more institutions, financial advisors, and regular investors become engaged these days, volatility decreases and Bitcoin's standing as a respectable asset class is established. To remain up to date on the most recent developments in Bitcoin, cryptocurrencies, and the digital economy, please take a moment to like this video, subscribe to the channel, and enable post notifications. Remember to leave a comment below with your thoughts. Let's get back and watch more clips from the interview.
What are the first principles reasons why crypto is so cyclical?
It's because it's so early and it's so promising. Let me unpack that a little bit. Mostly, traditional investors don't get involved in markets until they're relatively mature, right? Until they're public equities, and these are companies that have grown up and maybe have $100 million in revenue or more, and they're well established. Crypto opens that up. You can invest in a protocol that is just emerging today. Indeed, when Bitcoin started, it was publicly traded before basically anyone knew what it was. So you're getting in early. And then these are very exciting, promising technologies that are going after very large markets. Bitcoin is the best performing asset of all time. It's compounded at 100% per year. What happens in markets that go up a lot? And this explains the cyclical piece of it. What happens in any market that goes up a lot is investors start building leverage on top of their positions. They start maybe over-investing. They get overexcited and overhyped. We see this outside of crypto. You see this in any technology area. It goes from skeptics to mainstream to overhyped, and then there is a reset. The same thing happens in crypto. Because it performs so well, it attracts a lot of money, and the market gets overheated, and then there is a pullback. But the important thing to remember is we've had multiple of these sort of boom and bust cycles in crypto. But when it pulls back, it doesn't go back to where it started. There's a shift from speculative to more fundamental investors. That's absolutely true. And there are more types of investors coming into the market, right? Institutional investors, financial advisors, those didn't exist in the market beforehand. But there is also just the reality that it's becoming less risky over time. 10 years ago, there was a reasonable chance that there was some unknown in crypto that would cause it to not work in the market, right? There was something that would blow up in the space. That no longer exists, right? We've now been around for 15 years. The likelihood that crypto goes to zero has been dramatically reduced, and that naturally compresses the volatility in the market. I think blockchain is a fundamentally transformative technology, one of our most important technological leaps. It can be applied to do many different things. Bitcoin uses blockchain to create a public form of money, a digital gold. And I think it's one of the most important financial innovations in a long time, has plenty of room to run. But there are other things you can do with blockchain. If you look at Ethereum, they're using blockchain to create sort of a new internet for money and finance and social networks. That's very exciting. I think about Ethereum as a technology investment. Like it almost belongs in the NASDAQ. People are building applications on it like you would build an application in the Apple App Store. So if Bitcoin is money or gold, Ethereum is technology, sort of belongs amongst the Mag 7 tech stocks. I think that's a good way for investors to start thinking about this asset class. If Bitcoin is money or gold, Ethereum is technology, sort of belongs amongst the Mag 7 tech stocks. I think that's a good way for investors to start thinking about this asset class. So the first level is the US already owns about 200,000 Bitcoin from seizures, particularly in the very early days of Bitcoin from Silk Road in 2013 and 2014. I think the odds that we keep that Bitcoin instead of selling it are extremely high. I would say above 90%, right? Almost a certainty. And that's really important. One of the reasons Bitcoin traded sideways for much of 2024 is that governments were selling their Bitcoin around the world. So will we keep that Bitcoin? Almost certainly. The likelihood that the government starts buying Bitcoin, I think is something like 25%. I should put a note on that. 25% doesn't sound like much, but that is an extraordinary fact compared to where we were.
Is it already priced in?
No, I think it's not priced in at all. I think if the US government's not one bit. If the US government starts buying Bitcoin, I think you're looking at Bitcoin at 500,000 or $1 million a coin within, a period of a year. Because it won't just be the US government. If the US government is buying Bitcoin, you can believe that nearly every other country around the world is going to buy Bitcoin.
According to Matt Hougan, the revolutionary potential of cryptocurrencies can be seen in their promising innovation and early accessibility, in contrast to traditional markets, which are frequently controlled by established businesses with steady income streams. Cryptocurrency enables investors to participate at the inception of cutting-edge innovations. For example, early adopters of Bitcoin had a distinct edge in its growth trajectory because it was openly traded before the majority of people even knew what it was. He points out that with an annualized return of 100%, Bitcoin is the best performing asset in history. Nevertheless, speculative activity is drawn to this spectacular performance, resulting in boom-bust cycles. These cycles are similar to those of any high-performing market in that unsustainable highs are produced by over-leverage and over-investment, followed by required corrections. However, Bitcoin's resiliency is what makes it unique. It sets higher lows with every decline, indicating its increasing acceptance and underlying strength. According to Hougan, the cryptocurrency business has changed dramatically in the last 10 years. The industry is no longer exclusively controlled by speculative retail investors, and early concerns of catastrophic failure have mostly subsided. The entry of institutions, financial advisors, and long-term investors has improved the asset class's credibility and decreased volatility. With Ethereum acting as the backbone of a new internet for money, finance, and social networks, and Bitcoin acting as digital gold, he contends that blockchain technology is among the most revolutionary developments of our time. Take a moment to like this video, subscribe to the channel, and turn on post notifications for more insights like this. And as always, happy investing.